what I'm going to do today, I'm going to give you all a peek into the future, what we're seeing and what we're acting on here at Shadow Ridge. And basically, as Ryan said, we're starting to see that we've got a recession on the horizon, and the odds are sort of increasing every day that that's going to happen. Let's say you have 2% growth in your population between births and immigration. You need 2% growth in the economy, or the overall standard of living is going to be sliding backwards. If everyone wants to you want to keep the same standard of living, you need to have growth that's at or above economic growth, above population growth. So that's the important part. A century ago, economic recessions where the economy stops growing and starts contracting, were really regular affairs. Every 2 or 3 years, sometimes as quick as 18 months, one would follow each other. Over the years, the policymakers have gotten better at managing the levers of the economy and have moderated that. A lot of these recessions were caused by industrial inventory buildup of raw materials that would back up, or finished goods that weren't being sold. And all of a sudden, when these inventories built up, they had to lay off workers to slow down the manufacturing rate until the inventory was used up. So we had this boom and bust cycle that we've sort of gotten away from. Part of it's because we don't have a manufacturing dependent economy anymore. We're more dependent on services, which doesn't have this inventory issue. Now, the big thing about recessions is they typically are paired with bear markets. And Ryan mentioned bear markets and showed you a few of them. Since the year 2000, we've really had only 2 really big bear markets. 2000 to 2003 was one caused by the dot-com bust, the technology bust. And then in 2007 to 2009, financial issues caused another one. And if you include the COVID crash, which was so short, I don't really count it as a full recession, we've had losses of 33%, 52%, and 56%. If you have a 56% loss, it takes 116% gain to earn that back. Now, how often do you see investments that gain 116%? That's a really deep hole to dig yourself out of. Now, the decline portion of a bear market lasts about 18 months on average. The 2000 and 2003 was almost a full 3 years. The one in 2007 to 2009 was about 18 months. But it takes about 36 months to dig yourself out of that hole. Now, if you've got 5 years between the down cycle and the upside where you haven't really earned anything, if you're an income investor, what you see is steadily declining account values. It can be really devastating over a long period of time. Now, this is what I refer to as the lost decade. Not just me, but a lot of pundits. In the early 2000s, we had these 2 bear markets, 2000 to 2003, 2007 to 2009. And this red line is the S&P 500 index. I use that sort of a proxy for the stock market as a whole, because about 80 cents of every dollar traded in U.S. stocks is in the S&P 500. So it's pretty representative of our economy. Now, if you look at the end, this red line, the S&P 500, is below where it started. That's why they call it the lost decade. 10 years without any gains. And we're facing one of those situations now. The setup now, compared to the year 2000, is stock valuations are at historic highs. You're paying so much more per dollar of earnings, which is why you buy a stock, that it compares almost exactly to the year 1999 and early 2000. Very high valuations. And the stock market eventually is going to correct that. And that's what happens here. So we could be facing this. I used a statement in my newsletter a few weeks ago that I think we're facing a 1 step forward, 2 step backward type of market for the foreseeable future. And this is what it looks like, this stair step down. These little bumps up, this is what Ryan refers to as a bear trap, because then the trap snaps shut on you, another bear trap. This is what it looks like in real life. This is the actual 2007 to 2009 recession. And you got a 10% decline followed by 7% gain. 11% decline, small gain. Small decline, actually larger gain. This is a real bear trap. I think Ryan showed you this in his thing. But this stair stepping down is characteristic of bear markets. And that, I think, is what we're facing. Our number one goal is at Shadow Ridge is to make sure that you, as our investors, never have a life-altering financial event. And to do that, right now, we're starting to focus more heavily on holding cash, holding much more stable investments. Ryan talked about our market neutral strategy. And personally, I'm running an inflation model that focuses on investments that do well in inflation, and it's doing really well this year. But one of the things that we also do is we make a point of stepping aside. When these bear rallies are underway, we try and participate. But as soon as they start to go down, we'll get out of the way. Okay, this is what differentiates Shadow Ridge advisors from the ordinary financial advisor who just encourages you to be patient and the market will recover, et cetera, while you experience maybe a loss of half of your account. That's just not the way we do business. To give you an idea of how this works, here's a simple strategy that we use. And this is that same time period where the stock market has dropped 56%. You can see that right up here. This is, again, the red line is the S&P 500. Everywhere on this chart, the S&P 500 is the red line. The purple and yellow lines up here are momentum indicators. And when they cross, like they did right here, it gives us a little signal saying get out of the red investment and get into the green investment, which in this case is we programmed to be just a money market fund. That's why it's so stable. We got a momentum upswing here with that bear trap. We got in, we had to get right back out, and then we ride it out. The S&P 500 index lost 56% of its value during this time. This strategy wasn't perfect. It still lost 7%. So it's not perfect. It's just very, very good, because that kind of a loss leaves you with 93% of your principal intact to take advantage of the buying opportunity at the end of the bear market. Everybody else was starting out with 44% of their principal intact and had a much deeper hole to dig out of. If we're successful in this bear market over the next year and a half, we're going to be able to preserve the vast majority of your market value or your account value, maybe even make it grow. But the key is we're going to have a lot of cash for you at the end of this bear market when you have the buying opportunity of a lifetime. When we can buy stocks and funds that people really want right now, we can buy them at maybe half price. That's what we're looking forward to. So we believe we're well positioned for this bear market and a recession by holding lots of cash, conservative investments, using hedging techniques, and focusing on right now in this market, investments that do well in inflation, because that's part of what's driving the economic malaise. So if you know someone who's worried about their investments or you're worried about yours that we don't already manage, the best thing you could do for your friends is to relay a copy of the link to this recording or perhaps one of our newsletters to them and say, give us a call, because we think we can help you in this kind of a market.